Welcome to this explainer. Today, we're putting on our financial advisor hats to dig into one of the most fascinating macroeconomic shifts happening right now: Nigeria's bold pivot toward digital monetary sovereignty. We're looking at a system built completely from the ground up to fundamentally alter how money moves across borders.
So here's the massive question we need to answer. Can a state-backed digital asset, specifically Nigeria's e-Naira, actually bypass traditional Western financial chains? This isn't just some theoretical tech experiment. It's a structural necessity born out of intense economic pressure. We're going to evaluate the risks, the rewards, and the real-world friction of this system.
Here is our roadmap for today. We'll be looking at the dollar dependency problem, the sovereign digital upgrade, wholesale trade finance integration, the PAPS exporter advantage, bilateral corridors, and finally, the stablecoin risk factor. Let's get right to it. Section 1, the dollar dependency problem. Let's start with the current market frictions so we can understand exactly why a digital pivot was basically an economic necessity. Right now, if you're an emerging economy, the structural inefficiency is just brutal. With the legacy USD model, routing African trade requires clearing intermediaries, typically Western correspondent banks in places like New York or London. That locks up your capital for 2 to 5 business days. But compare that to this new sovereign digital blueprint. It uses distributed nodes for near-instant real-time settlement. It's a night-and-day leap in operational efficiency.
And all of this is happening against a really tough backdrop. Africa is dealing with what's called a lost correspondent trend. As Western anti-money laundering frameworks get stricter, compliance costs absolutely skyrocket. Global banks are simply severing ties to de-risk themselves. This economically disconnects West African businesses, causes massive dollar liquidity chokeholds, and practically forces them to build an entirely new alternative architecture. Section 2. The sovereign digital upgrade. Let's look at the actual underlying asset itself, the e-Naira, and how it evolved from a simple retail experiment into a heavy-hitting national payment rail.
When the Central Bank of Nigeria launched the e-Naira back in October 2021, honestly, the network effects were pretty weak. But then early 2023 hit. There was a severe domestic cash scarcity, and suddenly, e-Naira transactions spiked by 63%. Recognizing that potential, authorities aggressively repositioned the asset. By mid-2026, they introduced the Payment System Vision 2028 strategy, shifting the e-Naira away from just buying groceries to handling major government payments, international remittances, and cross-border trade. The mechanics underneath it all are actually pretty fascinating. Technically, the e-Naira runs on a secure, two-tier, permissioned, distributed ledger. The central bank holds the keys, retaining sole authority to mint tokens via its digital currency management system. Meanwhile, approved commercial banks run the validator nodes. This means these approved institutions can just settle up directly with each other. They can skip those intermediary clearinghouses entirely.
Section 3. Wholesale trade finance integration. Now, the true scale of this whole de-dollarization model really relies on massive institutional integration.
Let's walk through how this works in practice. Say a Nigerian exporter in Lagos prices their goods in local Naira, while an importer in Accra pays in Ghanaian cedi. A regional infrastructure called POPSAS then steps in to execute a daily multilateral net settlement in local fiat. The transaction completely bypasses the need to source physical US dollars. The wealth is kept within regional markets, and corporate balance sheets are suddenly shielded from the wild volatility of Federal Reserve interest rate shocks.
To really support this, the 2026 expansion fundamentally transforms the digital token. We're talking about the testing of tokenized trade finance instruments, highly programmable cross-border remittances, and digital letters of credit. Plus, the government is using it as an enforcement anchor by directly dispersing welfare and civil servant salaries through the e-Naira. That guarantees the baseline of domestic liquidity, turning the token into a genuinely robust trade financing tool.
Section 4, the PAPS exporter advantage. So what does this actually mean for businesses? How does it translate into measurable financial benefits? Let's talk about systemic cost leakage. Under the old USD correspondent model, an estimated $5 billion, yes, billion, is lost annually across the continent just in foreign exchange spread fees. It's a massive drain. The PAPS and CBDC blueprint, it reduces that transactional friction overhead by up to 90%. As a financial advisor, if you can tell a corporate exporter they can recover a share of $5 billion previously lost to middlemen while also getting complete data sovereignty, that is an undeniable, massive bookcase.
The ultimate endgame here is unlocking sheer trade potential.
by combining the digital rails of the eNaira with the regional clearing network of PAPS. They are physically and digitally formalizing intra-African trade. It empowers businesses to freely transact across borders while settling in their own local currencies.
Section 5. Bilateral corridors over time. Zooming out beyond domestic borders, let's look at the geopolitical strategy of forging direct payment routes with major global trade partners. The long-term vision outlined in the sources is an incredible geopolitical shift, creating direct CBDC to CBDC bilateral settlement corridors. That means bypassing SWIFT messaging queues entirely. By testing corridors like an eNaira to eCD link with Ghana or Project Cocoa with South Africa, Nigeria is actively drawing an alternate map of global trade routes. It's about building a totally parallel financial infrastructure.
And the state is pushing these de-dollarization tactics hard. Consider the crude for Naira policy from 2024, which mandated that domestic crude sold to the massive Dangote refinery had to be paid in Naira, not USD. Or the rules stating that all diaspora remittances must first route through local Naira settlement accounts. They are actively capturing those vital foreign exchange inflows into official domestic pools. It's a deliberate state-led strategy to cut demand for the US dollar and boost local currency resilience.
Section 6. The Stablecoin Risk Factor. Okay, the sovereign blueprint sounds amazing on paper, but as your advisor today, I have to give you the bear case too. Because out in the real world, the open market is speaking a very different language.
$59 billion. Just let that sink in for a second. Between 2023 and 2024, Nigeria pulled in roughly $59 billion in crypto inflows. That number points to a massive, glaring friction between what the state wants and what regular citizens are actually doing.
Get this. Nigeria holds a dominant 60% share of the entire sub-Saharan stablecoin market. Despite all the state's efforts with the eNaira, everyday citizens and businesses are overwhelmingly choosing private digital dollars, like USDT and USDC, over the state's sovereign token.
And honestly, the reason is simple. The eNaira is state-controlled, meaning it's subject to local Naira devaluation. Private stablecoins, on the other hand, are pegged to the US dollar, providing a critical digital hedge against inflation. Even regional commercial exporters are showing resistance. When it comes to preserving capital, human behavior means people will choose the safety of a global reserve hard currency over a local digital token, no matter how efficient the rails are.
Which brings us to the macro risk profile. If organic network effects stay weak, or foreign counterparties simply refuse to accept the eNaira, the system stalls. And there are serious cascading pressures here. You've got potential digital bank runs or capital flight if cross-border conversion gets too easy, technical vulnerabilities in the central ledger, and clear anti-CBDC regulatory pushback from Western financial centers. You can see how this entire de-dollarization effort could just fizzle out if not managed perfectly.
We've looked at the massive efficiency gains, the strategic bypassing of correspondent banking, and the stark reality of stablecoin preference. So the ultimate question remains, will encrypted ledgers and regional clearing networks like PAPS really be enough to erode the conventional hegemony of the dollar in Africa? As we wrap up this explainer, I'll leave it to you to weigh the systemic risks against the profound rewards of this wild new multipolar financial architecture. Thanks for joining me on this deep dive.